The Dow, after trading lower during the day, finally closed up above the T-line. So if you observe the obvious, the T-line's been acting as an uptrend support level, and as the very simple T-line rule is, as long as the indexes continue to trade above the T-line, you're in an uptrend. So the Dow is in an uptrend. But the NASDAQ, after closing below the T-line, is trading below the T-line. What's that tell you about your overall market trend? That the market trend is still probably in progress, an upward trajectory. But there are some sectors that are selling off, and there's other sectors that are being bought. Knowing this, an investor can take advantage of being both long and short in the portfolio. Our recommendation of being in SFIX, SFIX, was based upon the fry pan bottom and that it's been staying above the T-line. This makes investing very simple, just using these very simple indicators that as long as you're above the T-line, you can stay long. On the other hand, our recommendation to go short in Western Digital, even if you miss this move right here, we know what a bearish J-hook is. Notice that we have very simple indicators to tell us that the bears are definitely in control. There's a doji followed by a gap down. That's what you call your bearish best friend. A doji followed by a gap in one direction or the other tells you not only have they made up their decision after an indecisive trading day, but that decision is probably going to carry through for a while. Note what's happened over the next 3 days. This is a bearish doji sandwich. A big down day, a doji, another big down day about the same magnitude as the first big down day, with the doji sandwiched in between. This implies there's still more downside. So when you analyze the overall chart, you've got a wave 1, wave 2, now wave 3 in progress that could take you way down lower. When you can add many indicators to your visual analysis, it just helps you with the probabilities of being in the right trade at the right time. BZUN, BZUN, was recommended as a short because of an evening star signal right here at the 50, a close below the T-line. There's kind of your bearish doji sandwich again. Where's the next likely target? If you're starting to go short, more than likely down here at the 200-day moving average. And our recommendation to go short on Weight Watchers was based upon witnessing a shooting star doji, which we'd also considered an abandoned baby, which is a one-day island reversal, a close below the T-line, and now they didn't support at the 200 or at this level, telling us we've got wave 1, wave 2, with a strong force on that doji gap down going into wave 3. Using candlestick signals and patterns allows an investor to identify what usually happens in human nature time after time and produce high profit trades. Establishing long positions in October live cattle was based upon the stochastics being in the oversold area, a bullish Harami inverted hammer, and then it started trading positive after that. Yesterday they had a doji right on the 50 or on the T-line, and today they gapped it up. Again, there's our best friend with signal stochastics coming up, giving us the probabilities that we're going to go much higher on lean hogs. This is not rocket science. Investor sentiment works the same way time after time. Identifying a candlestick reversal signal in the oversold area produces a probability of being in the right trade at the right time. That'll be it. We'll see you in the chat rooms.